Hello, this is Jordan, and this is your precious metals video market update. This is being recorded on the evening of Sunday, January 14th, 2018. Thank you so much for joining me today. And in this video, I'm going to discuss the now promising outlook for precious metals this year, 2018. And let's start off with the daily bar charts of the gold stocks, and that means the large caps with GDX and the juniors, but they're really the larger juniors, or you could say the senior juniors with GDXJ. And it's been over a month, or about a month or so, since we did our last video, and we were less optimistic then. We were looking for a rebound around 21 for GDX and 29.50 for GDXJ, and the markets in December, I should say these ETFs in December, they did bottom within 1% of those targets. However, we weren't looking for that big of a rally into January, but what happened is the miners really blew past our targets, and they blew past those targets just immediately, almost within the first week. And so the kind of rally that we've seen, this rebound and this advance, I mean, this is impulsive action, similar to what happened after the January 2016 low, somewhat similar to the low in December 2016. Although I think this rally is going to have more staying power. Now, I think what's most notable here in the very short term is both GDX and GDXJ, or I should say, both of them, the recent pullback last week, which bottomed, I think, Tuesday or Wednesday, or really Tuesday. Note how the ETFs basically bottomed around the 200-day moving averages. And you could also look at, I believe, GOEX, which is the Explorers ETF, and I have my own junior index, which is has a median market cap of about 100 million or maybe 120 million. But essentially, we look at most of these indices for the miners or the juniors, and the low last week, they bottomed at the 200-day moving average, and since that low, they saw a really nice rebound, especially on Friday. GDX has already pushed above the June and October highs, right in the high 23s, and GDXJ has not done so yet, but I mean, it's within pennies right there at about 35. So GDX is on its way to testing what is very important resistance there at the mid 25s. We're talking about the September highs, and look, if GDX breaks above the mid 25s, it's going to be at a new 52-week high, and I mean, that hasn't happened since early 2016. And for GDXJ, assuming it pushes higher here, it should be able to get to the September high around 37.5 or 38-ish. If it gets to 38, that could be the highest in about 10 or 11 months or so. So GDXJ, in the big picture, lagging GDX a little bit. But the point here is that on this rebound since December, it looks like miners are going to run all the way up to the September highs. And I mean, that's significant resistance, because if you're a bear here and you really want to stop this market in its tracks, I mean, your last hope is going to be that resistance, again, about 25.5 for GDX and 38-ish for GDXJ. In the very short term, I think the miners are going to rally up to those targets, and we'll probably get some kind of a correction after that. That rally, that would, up to that resistance, that's 6% upside for GDX, about 8% upside for GDXJ. And so the short-term trend looks good here, and so does the medium and intermediate-term trend. Things look really promising after this rally. It's exactly what we wanted to see coming out of that December low. The strength definitely surprised us, but as many of you guys know, I tend to be too conservative, so that's a good thing. Now, moving on, let's talk about gold, because gold is setting up just really, I don't want to say perfectly, but it's just setting up very nicely. It's setting up for a very big move. Now, I'm not going to spend much time on this chart, but we're looking at the volatility indicators here. And some examples of those are Bollinger Bandwidth. Those are the first two indicators at the bottom. The third one is GVZ, which is actually a contract that's traded it's the gold VIX, basically. Just think of it as the VIX for gold. And then the last one is the average true range indicator. And all these indicators are essentially trading around 10-year lows. So volatility indicators are trading at near decade lows, and that's very significant because when volatility is really, really low, it tends to lead to a spike in volatility, and that that happens a lot when, I shouldn't say a lot, but that tends to happen when a market is kind of trading in a range for a long time, and then it breaks out of that range. And of course, if it's a significant breakout, it should have some legs, and the market should move higher. And that's accompanied by rising volatility, which happens from a point initially of very low volatility. And last thing here, I just want to talk about, I highlighted here the horizontal lines, some other points in time where volatility was really low. Early, middle 2005, I mean, that was a massive breakout for the sector. Volatility was really low. GVZ wasn't trading then. You go back to the middle of 2007 or the third quarter there, volatility was low again. And then after that, there was really low volatility at the end of 2012, early 2013. That, of course, was a negative for the market as there was a major breakdown there. And then volatility started to compress again at the end, I shouldn't say the end, the middle of 2015. But there wasn't a big move there initially. The market, it rallied, and then it went to a lower low before it exploded over the next 6 months. But where we are here and now, I mean, this could be the most significant breakout type move in gold probably since the middle of 2005. I mean, we're working on almost 4.5 year plus range, we could say. I mean, it's a very big range, but it's been occurring for almost 5 years. Now let's talk about gold here with a band of moving averages, and this is a weekly bar chart. I just have the 80-week, 100-week, 120, 140-week, 160, and this band of moving averages, what has happened in the last year is that these moving averages are now in perfect bullish alignment. So in other words, the 80-week is higher than the 100-week, higher than the 120, higher than the 140, higher than the 160, and that wasn't the case several quarters ago. So at some point, I can't zoom in here, but at some point, maybe in the middle of 2017 or so, all these moving averages started or they formed bullish alignment. And the last time that happened where the market, the last time the gold, these moving averages were in bullish alignment was at the end of 2012, which of course was a major secondary top. But the last time the alignment of these moving averages turned from not positive to everything in positive and bullish alignment was 2002, 2003. So that's a very good sign that the market is getting ready to mount a real test of resistance around 1350, 1375-ish. And at the bottom there, we have the net speculative position as a percentage of open interest. That's how we look at the COT. And as you guys probably know, I mean, the COT has been really encouraging. The low in December, the COT was around, I think, 26%. And the past reading last Tuesday, as of last Tuesday, was 39.6%. And if you look at where the recent extremes, the last three major peaks in the market, 2011, 2012, and 2016, the first one in 2011 was 54%. The last two were 56%. So gold can definitely rise here a little ways, more than just a percent or two before the net speculative position gets up to that 56% level. However, one thing we should note, and this is why you can't base everything on the COT so religiously, look at the highlights we have at the bottom in 2005 and 2009. Remember we talked about the 2005 breakout in the last slide. Look at 2005 and 2009. The net speculative position was very high into those breakouts. So the market still broke out and it still traded much, much higher, even though there wasn't that much of an increase in speculation. So perhaps that is the commercials the users, the producers, the hedgers of gold. Perhaps that is them believing in the breakout, seeing that the market can move a lot higher. But the reason is not really important. What's important to note is that if gold is going to make a major breakout, and the COT is high around 56%, the action from 2005 and 2009 tells us we should not be that concerned about the COT. If gold's going to break out this year, it's going to happen regardless of where the COT is, because that's what history tells us. Now, one other thing to consider, everything looks good, everything's lining up good. If I'm going to play the bearish card, I would say gold against foreign currencies at the top there. I still want to see it break above that red line. Gold against the S&P 500 has been really weak. So this move has been driven mostly by U.S. dollar weakness. U.S. dollar just broke below 91. Looks like it's probably going to decline to the next area of support, which is 88. But I think if we're going to see gold make this massive move higher, get up to that thin zone, and trade up to 1550, 1600, 1700. For that to happen, we really need to see gold show a lot more relative strength. So we need to see gold against foreign currencies break above that red line, break to a new high, around the same time gold would do so in dollar terms. As we know, the stock market has absolutely been on fire. It is, I believe, almost at the point where it's made a record for the longest amount of time it's gone without correcting 5%. So I think at some point this year, we could see a 7 to 10% correction in the S&P 500. And, that potentially could be a good thing for gold. Maybe that coincides with or around the time of a gold breakout. I mean, you also have, we're not going to talk about it in this video because we don't want it to be too long, but you also have long-term bond prices, which are at the cusp of a major breakdown. And you go back in the last couple months, and gold is starting to. Remember, it was positively correlated with bonds. Bonds are starting to perform poorly, but gold is still holding up and looking like it's going to break out at some point this year. I think that's because gold. We wrote an article about this. You can go to thedailygold.com and read it. I'll just leave it at that point. But essentially, major breakdown in long-term bond prices looks like it could be another driving factor for gold. Gold is looking really strong against bonds. It's doing really well, but I really want to see gold show some relative strength. I want to see that pick up as it gets close to making a breakout. That would be a good sign that the breakout would be really sustainable. So we'll see. Again, stock market is probably going to have some kind of correction this year. I think that should also help gold. And last but not least, we always use this chart last, but we have GDX and GDXJ, and there's a few key resistance levels. GDX, obviously, 2550. We talked about it in the daily charts. This rally should be able to get up to 2550, and maybe it pulls back. But once GDX makes a weekly close there above 2550 or so, it'll be at a new 52-week high. And, there's some resistance there around 28, but breaking above 2550, that's really the first step for GDX. And then the second step would be breaking the 2016 high. But given how long it's taken the market to get above 2550, I think that's more significant resistance. Down to GDXJ, because it's been lagging over the last year or so, there's actually three resistance levels. The first one there is around 37.5 or 38. So gold, or I should say the juniors, GDXJ, breaking above that level should take it up to the low 40s. It would be not quite at a 52-week high, but it would be significant. Then the second significant break would be surpassing the February 2017 high there. But with generally speaking, with the way the miners rebounded since the December low, that tells me, among many other things, that the market is in a bullish position now. You can go back to the first chart, just look at the GDX and the 200-day moving average. It traded above and below it a handful of times over the last year and a half. But where we are now, looks like GDX has retested the 200-day successfully. It's going to be trading above it. We'll see the 200-day moving average slope up. So are we going to have a massive breakout in the next couple months? I mean, we could see one above 25.50 for GDX and 38 for GDXJ. As far as when could this market test and break above the 2016 highs, who knows? But I thought the big breakout move would start around the summer. That was in my last video. Now it looks like the market is more bullish than I expected, and who knows? We could see that big breakout move sooner than the summer. But everything is certainly setting up really good for precious metals. I mean, the outlook for the next 12 to 18 months looks really fantastic. I mean, it's been a grind over the last 18 months or so. Just hang in there for a couple more months because it looks like we're on the bullish track now, and we could see some really fantastic gains over the next 12 to 18 months. That's all for this video. You can follow all my work at thedailygold.com. My premium newsletter, it's only $149 for 6 months. You can find that at thedailygold.com/premium. We focus on market timing and picking the right stocks. If you want to know which juniors have the goods and best potential, which juniors really have the potential to be 5 or 10 baggers, I urge you to consider subscribing to our service. It's highly affordable. Thank you so much for listening and watching this video. I really appreciate it, and I look forward to publishing another video update for you in the weeks ahead.